TheoTrade. This is Don Kaufman. October 30th, 2021, doing the TheoTrade weekend update on a Saturday morning. Some bad news for the bears. The great gamma squeeze, well, it appears to be very much back in action. We're going to talk about specifically the gamma squeeze as it relates to the S&Ps. We'll look at a little bit of the gamma squeeze inside of Tesla. And, well, for those of you that have absolutely no idea what that really amounts to, like what is a gamma squeeze, we're going to cover it here in detail. Well, right now, let's get down to business. So I say, degree of bad news for the bears in the overall marketplace as we explode higher. Now, within that, there is absolutely a degree of a cautionary tale that we are going to discuss in the latter portion, of course, of this weekend's update. When I say that, there has been, and I'm going to just detail this briefly, there has been absolutely massive activity inside of the bond market and the note market that speaks, well, volumes simply about the Fed announcement that will be out this next week. Risk is definitely growing inside of the bond market. Again, that and much more. Let's get back to it. This past week of trade is all about hedging activity against, okay, retail call buying. Now, I'm going to explain this, all right, a little bit in the S&Ps. Then we'll actually take a look and see the effects inside of a product like Tesla. So let's get down to it and go ahead and close up this left side bar. Just take a look at this chart here inside of the spiders. One of the great ways to explain a degree of the gamma squeeze, of course, is to look at what isn't just a relentless, if you will, move to the upside. And literally people look at this and they think to themselves like, how could you just want to buy? I just want to buy the all-time high. And it doesn't necessarily work that way. Like when you're looking at this and you're like, hey, listen, somebody had to be the buyer of the all-time high, whether it's here in the spiders, the QQQ of Tesla, you know. And I think a lot of people look at this and they say, well, I'm just going to throw in the towel. Okay, you know, screw it and just buy the marketplace, the all-time high. But that, in effect, is not really what's driving a lot of the trade. And you hear these terminology, you know, thrown around. It's a gamma squeeze. They're squeezing it to the upside. So, like, what, again, does it really amount to? That's exactly what we're going to explain. We've done this in previous sessions, but we'd like to kind of clarify for all of you that are either a little bit new or maybe a little bit, you know, not so much up to speed in the understanding of how hedging activity and the gamma squeeze in effect works. So to use the spiders, this is obviously like the marquee product out here. Let's get to work. Okay, in this example, if you were to go out, now you're a retail trader, you're to go out, okay, and you're going to buy. Let's say that you buy like the at-the-money calls. Doesn't matter what expiration, but most of the time if you're retail, and especially if you're doing this throughout the course of a trading day or trading week, you're buying something like these at-the-money calls, which should be basically like the 460 calls. Okay, so you're going to buy the 460 calls. I mean, those things could expire today. They could expire, you know, on a Wednesday, on a Friday. But you're buying the 460 calls. Doesn't matter what you're paying for them, but those 460 calls, because they're at the money, when you buy them, in effect, okay, that is going to allude to the idea that you are positive, okay, delta. Now, how many deltas would you have for the at-the-money calls? And the answer is you'd always have 50 deltas. So you'd be positive 50 deltas. If you did 10 contracts, you're going to be positive 500 deltas. So you're going to be positive, okay, 500 spider deltas. Now, when you buy those 460 calls, right, okay, this is the market maker. The market maker turns around and sells you those 460 calls. Now, when the market maker turns around and sells the 460 calls, they're actually going to be negative 500 delta. All right, so this is your market maker. Now, does the market maker want to take on a lot of directional risk? Of course not. And that's not their business. Their business is bid offer spreads, and the bid offer spreads in a product like these spiders are absolutely phenomenal. So what do they have to do? They have to hedge. Okay, so this is the market maker. Let's throw their hedge together. What is the hedge? The hedge is to actually offset the risk in the easiest way. What do? They just go out there, okay, and buy shares. So I'll just say buy SPY. How many shares? Well, they're going to buy at least 500 because that'll give you 500 deltas, which makes them net zero. Now, what happens? You went out and bought calls. Because you bought calls, it caused them to have to sell the calls. When they sold the calls, then they had to turn around and buy stock. When they buy stock, what does it do? Actually causes the marketplace to move higher. But here's the interesting thing. When they buy stock and the marketplace does perpetuate to the upside, you know what happens? Somebody else comes in there, okay? And then they're buying, for instance, the 465 calls, right? And buy the 465 calls, and maybe those are like another 300 delta. So then it adds what? Oh no, it makes them short 300 deltas. What do they have to do? Buy more stock, another 300 shares, and it actually continues to perpetuate. This is the great gamma squeeze. It's the great gamma squeeze, which is never ending. It's relentless, and it's this move to the upside. And literally you get locked, if you will, in like this spiral to the upside where retail is buying calls, then there's hedging activity. You know what the interesting thing is? Even after retail traders, like they just drop out. They're like, this is crazy. Okay, there's still hedging activity that'll drive you to the upside. Now, okay, that is, again, what I kind of termed the great gamma squeeze. And I think it's, you know, it's absolutely essential to understand that that's what's driving markets. There's no fundamental reason, if you will. And I know everybody would argue that, oh, you're talking about Apple's earnings were what? They were garbage. You know, oh, but Amazon was what? Guided lower? Yeah, they did. Okay, and you look at this, but it doesn't make a difference because you're caught up in a squeeze. And if you look at the S&P futures, this is actually where the market making firms hedge. And the S&P futures, even into the close today, all they're doing is just hedging off a degree of the delta. And again, it's not about directional bias to the market making firms. To them, it's just about hedging off the activity. Then you look at something like Tesla. Now Tesla's got all kinds of crazy things going on. Tesla, the gamma squeeze is so phenomenal in here that when you start to open up the option chains, you can see I've got positions. When you start to open up the option chain and you look at the implied volatility. So what I'm doing here is I'm actually going into the option chain itself and I'm pulling up, okay, the implied volatility of each unique option. And one of the things I want you to see inside of Tesla, look at the implied volatility of the calls. The skew actually bends to the upside, which is just absolutely indicative of a squeeze. What's going on is out here, these calls, right? The at-the-money calls have 57 vol. The out-of-the-money calls have like a 67 vol. There is so much demand for out-of-the-money calls that they're actually raising the price. It's shifting the skew, if you will. And by the way, I love to take the other side of that trade because oh, well, look what I've done here. I went out and actually sold these. In fact, I don't sell a lot of them. You have to have portfolio margin to be able to do this. But I sold calls the other day, and I just want to show this trade because it's contrary to popular belief. But when there's inverted implied volatility skews that are of this magnitude, you actually can sell calls. The stock goes flying higher, and yet you still make money. It has nothing really to do with the time decay. So here is the look. Okay, I put this trade on October 26th, and I sold the 2,000 calls in the November 19th expiration. I was able to sell them for $2.30. They're currently trading, okay, for, oh, let's call it 80 cents, right? So I could buy them back right now easily for 80 cents. So, you know, we're up on a percentage basis quite significantly. How can that be? If you take a look at Tesla, all-time high, okay? Because it's called what I term slipping down the skew. And I'll just give you a quick example of this because it's just so important to understand. So you go out here, all right, and you sell, all right? You sell this way out of the money call. Even if the market starts to rally to you, as the market rallies to you, your almost 100% implied volatility would slip down. And for instance, being like a 75 volatility, okay, it is shocking right now when you look at the skew inside of something like Tesla. What am I telling you? I'm telling you the demand is so freaking high for Tesla calls, okay, that people will just basically pay anything for them. They don't realize that that skew is a massive deficiency against you in being able to actually make money buying calls in something like Tesla. But it's also more evidence of the great gamma squeeze is back, okay? Watch Nvidia. Nvidia also has just a wicked gamma squeeze going on. This one, though, is still fairly early in its livelihood. It doesn't mean it's necessarily going to continue to propagate, wild returns over here. But the skew right now is starting to take off also to the upside inside of something like Nvidia. But people, I'm going to tell you right now, this is what's actually driving your market. So it's more about hedging activity. Okay, it's not about like when people look at this, it's Apple, it's this. All right, so in the Great Gamma Squeeze, just understand hedging activity. As long as retail is out there, they're back, baby. They're buying calls like crazy. It's actually going to squeeze us to the upside. Now, some of that may be very well tapered this week because of the Fed, but we're going to come to that here momentarily. So, yeah, I would say that Tesla is very close to the upside of the squeeze. Could have a couple of last gasps for air. I would watch Nvidia very carefully. And Nvidia does have earnings. The earnings, though, are out in November 17th. So any trades that you would do November 12th, November 5th kind of expiration. And of course, the S&P 500 is squeezing to the upside right now, again, through the use of gamma. All right, so the next point to bank is Apple nor Amazon tanking can take down this marketplace. And that's, again, it's because of the gamma risk that basically is on the scene right now. So we did see, of course, Amazon here. And, I just want to, focus on this for a second. There's nothing to see here. Listen, we tagged the edge of the expected move. The expected move inside of Amazon was about $134 to my recollection. And by the way, what I'm referencing in this case is if you went back, okay, to Amazon, you took a look at Amazon right before the earnings. Just go back to the 28th. You go right before the earnings. You open up the option chain in here, and you go, look, it's $134. Right? I'm just going to open it up. It's $134. We tagged it pretty much to a T. We sat there, and then, of course, we rallied out. And we rallied out of it not because people are like, I need to buy Amazon. It's because ultimately, all right, the S&P started in their squeeze, which actually forces statistical arbitrage to turn around and buy some of the bigger stocks inside of the marketplace, Amazon being one of those. Same is true, of course, of Apple. Apple was spot on the edge of its expected move. Again, we take a look at Apple. It had... well, when I say spot on the expected move, it closed at 152.57, had about a $4.50 expected move. So, all right, where should it go? Well, pretty much smack on here, right into that 147, 148 handle where it sat, rallied out with the rest of the market in the remainder of the day. You look at products like Facebook just getting decimated recently in trade, got a little bit of a bid back under it. Again, there's no surprises inside of the tape to me. I mean, of course, people are going to point out, what about Microsoft? Well, Microsoft is one of the few tech companies that did have actually decent earnings, and it too is in the beginnings of what could apparently be some type of a gamma squeeze. Now here, I just don't see like that crazy kind of inflection point displayed inside of the skew just yet. But that is also in large part because Microsoft is using $2.50 increment strikes. A little harder to kind of read through some of the noise of options that are worth 13 cents or 18 cents. So I'll definitely keep an eye, though, on Microsoft here in the very near future to see if it continues to kind of squeeze, if you will, to the upside. This is just evidence, again, of some activity of the unwinding of options following, of course, their earnings announcement. All right, let's get to a completely different aspect inside of the marketplace, right? And that is simply in respect to the fact that what's coming. Okay, the gamma squeeze is absolutely prevalent, and when it comes to the gamma squeeze inside of the broader marketplace, there's no telling what actually knocks this off. Meaning that the gamma squeeze is in large part, it's indicative of a lot of retail activity. And I look at this, and I actually look at the numbers also that come out of the OCC, that's the Option Clearing Corp. And if you did look at the numbers over the weekend, it's staggering. The options marketplace did 47 million contracts on Friday, which is, again, it's indicative of like retail gone wild. But here we go, forward looking. All right. This coming week, and I'll take you into this coming week by a quick glance at the calendar. And, the calendar, obviously, everybody's going to be looking for, what is the Fed going to do? I mean, that's the big gorilla out there. I mean, this past week, though, it didn't matter. The marketplace missed GDP. Nobody cared. GDP was a far cry. It was supposed to be 2.7. I believe it was 2% GDP. Consumer spending really dried up. Don't worry. It's all transitory. You're going to find out what transitory means, of course, this week. And the event is, of course, the Fed. So, when you start looking around and hear, there's going to be this number and that number coming out, listen, nobody really cares. They're only going to care, is it going to be taper time here with the Fed? Now, the reason I'm bringing up the Fed, and again, we're going to talk a little bit about Fed momentarily, taper time. Okay, I picked up on something, well, very, very interesting. Maybe a little bit alarming, at least to me it is. And that has to do with bond volume. Okay. Why is there the massive movement in capital? So obviously everybody's going to tell me because it's the Fed. The Fed is coming and there's a massive movement of capital inside of the bonds. What I wanted to point out on this particular front, I'm going to close up this left side bar because I think it's absolutely imperative that we understand what's actually going on inside of the bonds or the notes. We could pull up either or. First and foremost, when you start taking a quick glance at it, okay, look at the volume of just the last 3 trading sessions inside of the bonds. Okay, it's huge. It's huge by huge. Now let's not just leave it there. I think that it is important to also pull up the notes. Okay, and this is stuff that maybe people don't necessarily look at on a day-to-day basis. And you look at this volume, which is, I mean, even the S&P futures. The S&P futures volume pales in comparison to what you're seeing inside of the ZN. Now you look at this, you go, when else does volume this large come out? If you look right here, you have to discount that. That is the roll. The roll doesn't count. The roll doesn't count. The roll doesn't count, right? When else do we see this kind of volume targeted inside of bonds and notes? I have an answer for you. There's some pretty huge volume. This is monumental volume, monumental volume. Those days that I just highlighted here, these days right in here, go back, take a look at this for yourself, okay? Don't take my word for it. Go back and look. Any big volume day in bonds and notes was met with catastrophically large moves, if you will, inside the S&Ps. Those were the days, okay, that the Nasdaq was actually moving upwards of 3% in most of those trading days where you saw just wicked volume. And again, I'll just bring this up here, and just a random day, like 617. Okay, what was the S&P doing on, for instance, I'll go to the spiders. What was the S&P doing on 617? You start to actually bring it up, and you're like, oh, I got it. The marketplace was just what? It was in the midst of, tanking a little bit over here, and the Nasdaq at that point was seeing just hideous moves. And again, I wanted to bring this to your attention because most people miss just that the bond volume very often, okay, was right on the forefront of some wild movement. And that wild movement wasn't always to the downside in the S&Ps. It was just downright wild movement in markets in general. It was actually some of the big reversal days that we saw such huge volume inside of bond and note markets. And I want to make that also clear that yes, the Nasdaq had 3% plus down days, okay, but some of these large volume bond days were also met with like reflexive bounces back to the upside. Nevertheless, we have 3 trading sessions, people, 3 trading sessions that are huge by huge, okay, in terms of volume. So I took a more detailed look and I'm like, okay, the roll is not going on right now. I wanted to clarify that because people go, well, is this a roll? It's not a roll. Okay. The ZN did trade basically 2.5 million contracts. Just compare that to the S&P futures. Okay. It's 1.3. And this is where you say what gives. I'll tell you what gives. There's a massive amount of capital moving prior to this Fed announcement. Doesn't exactly make me feel warm and fuzzy. So I dropped over to the TLT. The TLT also confirmed some heavy volume in there. But what I'm looking at specifically inside of the TLT, and I'll bring this into scope right now, is there anything wild going on in the option positioning? No, not really. IV rank, though, is really picked up in here. It's to the 43rd percentile. If you compare that to the S&Ps, okay, the S&Ps are at like a lower volatility rank. The bonds right now, their volatility is absolutely a rockin', okay, for bonds. It's not in like the most extreme category. Nevertheless, it is worth noting that the volatility is definitely bid, as it should be, given the fact that the Fed is going to come out. So this week, we're going to hear, of course, from Jerome Powell, the Fed. This is possibly one of Jerome Powell's last conversations. Oh, he is so very much out. But that's another conversation for another time. Some warning shots being fired across the bow right now. Throughout the course of this week, we have also, seen Skew has picked up dramatically. So for those of you that are premium sellers, well, sit back and enjoy it, because, one thing that we've had happen lately is that volatility has come down quite considerably. The VIX is back down and the 16 lever, oh no, I can't sell premium. But at the exact same time that the volatility is down, skew is really picked back up again. So those out of the money puts are trading for a huge premium relative to the out of the money calls. So again, premium sellers, you're just fine. The other aspect worth noting, of course, comes to play inside of the SPX. So we had, a nice up move again this week. We literally are we tagged the upper edge of the expected move. We came within, by the way, $5 of the edge of the expected move. Just to highlight this, the edge of the expected move was roughly at 45.99, and the closing price was 46.05. So within $5-6 of the edge of the expected move. I highlighted it, but that, people, is just basically a rounding error. And I've told you guys each and every week, pay attention to the expected moves. This is part of the great gamma squeeze. This is where markets, seek the edges of expected moves. The one aspect that should also resonate with you, this week the markets rallied, but this next week, the volatility did not collapse. In fact, the volatility expanded, likely because of the Fed. So there are several factors that do portray a much riskier situation. Obviously, the expansion of volatility, the fact that we've also seen the dollar explode back to the upside. The next conversation piece, of course, bond volume. I don't have a feel for what this is going to look like, post-Fed announcement. But again, volatility is elevating. Volatility inside of the bonds is clearly elevated, right? Skew is elevated. Everywhere you look, the dollar is elevated right now. So you talk about different risk metrics that we look at. There are signs of risk prevalent with the markets effectively grinding higher. It does not mean that a down move is imminent in any way, shape, or form. But at this point in time, wrap your risk rather tightly in here. If you're going to be bullish in the markets the coming days, the coming weeks, use spreads whenever or wherever possible. You go at this and you just buy a call, you're going to get crushed. People that are doing it in, Tesla and Nvidia, use a call spread. Buying an outright call is lunacy inside of this marketplace. Number one, the gamma squeeze could just come undone. Number two, going out there and paying a small fortune, for a call that I need a call. Buy a 60 vol, for instance, and sell a 70 vol. Put skew in your favor. Use spreads whenever or wherever possible. Again, everything on the screen right now, in terms of those risk metrics, point to more substantiated movement in this next week of trade. Yes, you have the FOMC, but it is also highly likely that we start to see moves and positioning prior to the FOMC announcement. So looking into Monday or Tuesday, definitely going to be some action inside of this marketplace. Again, heavy positioning prior to the FOMC announcement, likely to spark some more movement. Is it bad news for the bears that the gamma squeeze is back? Sure. But those gamma squeezes have actually been met in the past with some very, very wild volatility. With that, that's it for this weekend's update. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.